objective of most incorporated organizations is to create economic value. Those who have money invested in the enterprise want to see a return on their money, a return that exceeds the return that they would get if they invested their money differently, for example in a bond, a savings account, or a competing organization. Economic value is created whenever the return on invested capital in a corporation exceeds the cost of capital. This is visible in the basic value equation. Economic value created equals invested capital multiplied by the return on invested capital minus the weighted average cost of capital. Since the cost of capital cannot be changed easily in the short term, our focus here is on the return on invested capital. In this section, we'll show the link between the operational variables and return on invested capital. This is an ambitious task. Given this fundamental disconnect, managers and consultants often struggle with questions such as what performance measures should we track, how do operational performance measures impact the bottom line performance, or how do we go about improving processes to achieve various operational performance improvements, including cost savings, lead time reduction, or increases in product variety. The objective of this section is to provide students with a set of tools that support them in analyzing the operational performance of a company and to guide them in increasing the overall value of the firm by improving its operations. We will do this in 3 steps. First, we introduce the ROIC tree, also known as KPI tree. Second, we show how to value operational improvement opportunities. That is, predicting by how much the return on invested capital improves if we improve our process along some of the operational measures defined elsewhere in the course. And third, we provide examples of KPI trees and look at how we can read financial statements to get a sense of the operational performance of a company. We will illustrate the first 2 steps with a case study of a small furniture company. Let's now show how we can build a return on investment capital tree. We will show this by using an example of a small company, ABC Furnitures. Here is the example and the information. ABC production facility includes machines and other wood processing equipment valued at about $4,000 and $1,500. There is an annual depreciation associated with the machines of $80,000. Rents for the showroom and the factory amount to roughly $1,000 and $1,500 per year. Other indirect costs for the company are about $100,000 per year for marketing-related expenses and $180,000 for management and administration and $60,000 for a highly skilled worker in charge of finishing furniture and conducting a quality inspection. The company has 2 major types of inventory. There is about $20,000 tied up in raw materials. This is wood that is purchased from suppliers in large order quantities. When purchasing wood, ABC needs to pay his suppliers roughly 1 month in advance of receiving the shipment. There is also about $50,000 of work in process inventory. This corresponds to furniture that is in the process of being completed. Furniture production, especially in the high-end segment, is a very manual process and requires a highly skilled workforce. ABC employs 12 cabinet makers, many of whom have been with this company for more than a decade. The cabinet makers work about 220 days in a year, on average about 8 hours per day. The typical wage rate for a cabinet maker is $20 per hour. To finish a typical piece of furniture, a worker needs about 40 hours. The work is organized in work cells. Instead of having the cabinet maker specialize in one aspect of furniture making, a cabinet maker handles a job from beginning to end. Of their overall number of hours worked, cabinet makers spent about 15% of their time building fixtures and setting up machines. Given the modern production equipment, a good part of this includes programming computer-controlled machines. Since the cabinet makers are organized in work cells, it would be too expensive to equip each cell with all woodworking equipment. Instead, the cabinet makers share the most expensive tools. This leads to an occasional delay if multiple cabinet makers need access to the same unit of equipment at the same time. Consequently, cabinet makers spend about 10% of their time waiting for a particular resource to become available. From a design perspective, a typical piece of furniture requires about 30 kilograms of wood. In addition to this wood, about 25% additional wood is needed to account for scrap losses, primarily in the cutting steps of a job. Wood costs about $10 per kilogram. Purchasing high-end furniture is not cheap. Customers pay about $3,000 for a dining table. Typically, customers are expected to pay 50% of the piece as a down payment. They then receive their furniture about 3 months later. This delay reflects the custom nature of the end product as well as the fact that ABC Company's facility at the moment is fully utilized. That is, there is more demand than what can be processed by the factory. The owner of the company is primarily interested in creating economic value and thus in increasing the return on investment capital of his firm. The problem with respect to increasing return on invested capital is that ROIC in and of itself is not a lever that is under direct managerial control. It can be computed at the end of a quarter or a year, but while a manager might go to work in the morning thinking, today I will increase my ROIC by 5%, it is not at all clear how to achieve this objective. The idea behind building an return on investment capital tree is to cascade the high-level financial metrics into its key operational ingredients, thereby revealing the levers a manager can use to improve return on investment capital. Let's begin by writing down our overall goal. The return on invested capital equals return divided by the invested capital. Now let's do a simple manipulation and write this one. Return on invested capital is return divided by revenue, which is multiplied by the revenue and divided by the invested capital. The first ratio, return divided by the revenue, is the company's margin. The second ratio, revenue divided by invested capital, is called the company's capital turns. This simple, elegant way of decomposing the ROIC into margin and asset turns is often referred to as the DuPont model. DuPont has among the pioneers introducing financial performance measures to its business units. Companies and industries differ widely with respect to how they achieve a specific return on investment capital. Some industries are asset intensive. The capital turns are low, but their margins are significant. Others require little capital. Such industries are typically easier to enter for new competitors, leading to relatively thin margins. Now back to the owner of the company. As advisors to the owner, we can now help him improve his businesses by saying, to improve your ROIC, you need to either increase your margin or turn your assets faster. It is unlikely that this advice would ensure our future career as management consultants. Nevertheless, let's keep pushing the same logic further and now decompose margin and asset turns into their drivers. Consider margin first. Based on standard accounting logic, we can write the return or profits of the firm as revenue minus fixed costs minus production volume multiplied by variable costs. Because this is not accounting course, let's use flow rate instead of production volume. Given the above equation and keeping in mind that the revenue equals flow rate multiplied by price, we can rewrite the previous equation by dividing both sides by revenue, which yields the following formula. Using a similar logic as we used for margin, we can write asset turns in this way: flow rate multiplied by price divided by invested capital. And now, using those two formulas, our overall return on investment equation can now be written in this way. Because ultimately we want to be able to express the return on investment capital as a function of its atomic ingredients, such as wage rates, processing times, idle times, and so forth, we need to continue this process further. To avoid an explosion of mathematical equations, we prefer to write them in three forms. This is the tree form for the return on investment capital. Now we can see the price, fixed costs, flow rate, variable cost, flow rate again, price, and invested capital. We will continue with the example in the next lecture. Let's continue with the building a return on investment capital tree. Now consider the four variables that we discovered as drivers of margins in greater detail: flow rate, fixed costs, variable costs, and price. To focus our analysis in the operations aspects of this case, we assume price has already been established. In other words, we do not consider price to be one of our potential levers. Of course, we could take our operations-focused analysis and modify it appropriately to conduct a similar marketing-focused analysis that concentrates on the pricing decision. In general, though, we caution the reader not to build a machine with too many moving parts, especially at the start of a project. Looking at an operation in detail, one simply needs to make some assumptions. Otherwise, one runs the risk of getting lost in the complexity. Next, consider the variable costs. In our example, the variable costs are driven primarily by the consumption of wood. In some cases, one also could consider the cost of labor as a variable cost, especially if workers get paid part of their salary on a piece rate basis. Yet in our case, the number of cabinet makers, as well as their hourly wages, is given and thus constitutes a fixed cost. Focusing on wood expenses, we can write the variable cost of a piece of furniture in this way. Here is included the price of wood, wood in the final table, and the scrap or cutting loss. Now let's turn our attention to flow rate. The flow rate is the minimum between demand and process capacity. Because we assume that there is enough demand at the moment, flow rate is determined by process capacity. But what determines capacity in this case? The main constraint on this operation is the work of the cabinet makers. The number of units of furniture that we can produce per year depends on the number of available worker hours, which is determined by the number of cabinet makers multiplied by the hours each cabinet maker works per year, and the time a worker needs for a piece of furniture, which is determined by the amount of time it takes a cabinet maker to wait for a machine to become available, the time to set up the machine, and the actual time to do the work. This figure here summarizes these calculations in tree format. The figure also shows how we can make the tree more informative by adding the corresponding mathematical symbols into it. Finally, let's consider the fixed costs. They include expenses for marketing, the labor expenses for overhead, inspection, administration, rent, depreciation, and the cost of the workforce. This figure here summarizes the main components. It should be noted that one should be very careful how to measure depreciation. It is important to distinguish between the loss of value of a machine and the depreciation as it is calculated for tax purposes. Following the standard practice of valuation and corporate finance, our emphasis is on the former view of depreciation. Note further that we do not include taxes in our analysis here. We compute pre-tax return on investment capital. Combined our previous work, we now can extend the simple return on investment tree to a more complete picture of return on investment capital drivers, as shown in this figure. Note that based on this extended tree, we now have achieved an important part of our objective for this section. We have created a direct linkage between the return on investment capital and downward operational variables such as idle time, setup time, processing time, and flow rate. To complete our return on investment capital tree, we now need to turn to the asset turn branch of the tree and explore it to the same level of detail as we have explored the margin branch. Because we can take the flow rate and the price from our previous analysis, what it is left to be done is a refined analysis of the invested capital. Capital is invested in plant, property, and equipment, as well as in the three forms of working capital. Inventory includes the inventory of raw materials, wood, as well as all work in process, that is a pile of semi-finished piece of furniture. Prepayments to suppliers include money that we have sent to our suppliers, but for which we have not received the associated shipment of raw materials. And any money we are waiting to receive from our customers for products that we have already shipped to them. While in most businesses this part of the balance sheet requires an investment in capital, the situation in our case is much more favorable, as customers pay us a down payment well in advance of receiving their furniture. This line item actually corresponds to an inexpensive form of cash. For this reason, we should label this item unearned revenues so as not to upset any of the accountants in our company. The figure summarizes the components in invested capital in tree format. When we compute the amount of money that we need to invest in accounts payable, we first need to find out how much money we spent on wood purchasing every year. Because we have to pay our supplier 1 month in advance at any given point, we have 1/12 of the early payment tied up as capital. A similar logic applies to the unearned revenues. This completes the development of the return on investment capital tree. We now have expressed our key financial performance measure, return on investment capital, as a function of detailed operational variables. We have explained the behavior of the cell by looking at its molecules and ultimately at its atoms. Understanding the link between processing times, wage rates, and other operational variables and return on investment capital is certainly a useful motivation to illustrate that these variables are worthwhile studying. But are they also useful in practice? What is the benefit of all this work? The key benefit of the calculation defined so far is that we can now assign a value tag to each of the operational levels that we potentially might pull to improve our operations. As an owner, manager, or consultant of a company, one can do many things to improve the return on investment capital, such as cut wages, change the design so that the work required to make a piece of furniture is reduced, reduce the time workers spent waiting for a machine, reduce the setup times, change the payment terms with a supplier, and so on. But which of these actions are worth pursuing? All of them are likely to come along with some cost, and at the very minimum, they will require management time and attention. So which ones pay back these costs? Or put it differently, where is the juice worth the squeeze? We thus want to find out how a change in one of the operational variables leads to a change in return on investment capital. This can require a lot of tedious calculations, so it is best to conduct this analysis using Excel spreadsheets. This figure here shows our full tree in a spreadsheet format. It also populates the tree with numbers, creating a complete picture of the operations of the furniture we make. Here you can see the return on sales, margin, also the asset turns branch, and return on investment capital. Note that one variable might occur at multiple locations in such a spreadsheet model. Consider, for example, the variable flow rate. In this example, flow rate shows up in the revenue part of the tree here. It also shows up as a part of the material costs below. And finally, it also shows up in the working capital calculations as down payment depend on revenue and thus flow rate, as well as material costs depend on flow rate. Here. Thus, when building the spreadsheet, it is important to keep all these usages of one variable connected. Put differently, an increase in flow rate is not just giving us more revenues, it also creates more material costs, it adds working capital by increasing the down payments, and it reduces our working capital by adding to the prepaid expenses. Once we are equipped with such a spreadsheet model, we can easily find the impact of an operational variable by changing the corresponding cell and observing the change in the cell corresponding to the ROIC. Before we do this, let's develop some intuition. What will happen if we reduce the setup times by 5 percentage points, from 15% to 10%? Of course, shorter setup times are a good thing and we expect the return on investment capital to improve. If somebody offered us to reduce setup times for free, we would happily take him or her up on their offer. The crucial question is thus, by how much will the return on investment capital improve? What will happen to the root of our tree if we wiggle it at one of its leaves, setup time? Will the return on investment capital change by 1%, more or less? It is hard to answer such a question based on intuition. When we ask to make a guess without a formal analytical model, most people we know argue along the following line. There are many variables that influence ROIC, so changing one of them by 5 percentage points will have an effect substantially smaller than a 5 percentage points ROIC improvement. This logic is in line with the tree metaphor. If you wiggle a tree at any one of its leaves, you do not expect big movements at its roots. This table here shows that this argument does not hold. In fact, this guess is well off the mark. A 5 percentage point change in setup times leads in our example to an 18.8 percentage points improvement in return on investment capital. It raises ROIC from the base case of 12.3% to 31.1%. What looked like a small and, at least from a financial perspective, an important variable turns out to be a key driver of financial performance. When an operational variable behaves this way, we refer to it as an operational value driver. A couple of observations are helpful to better understand the role of setup times as an operational value driver. If we take a second look at this tree, we see that setup times drive return on investment capital in multiple ways. Setup time is a driver of margins, the upper branch of the tree. A shorter setups allows us to produce more and hence to spread out the fixed cost over more units. Moreover, setup times also impact asset turns. We get more revenues out of the same capital investment because setup times influence sales per year, which is a component of asset turns. This analysis is based on the assumption that there exists enough demand to support a 26-unit increase in sales. The new flow rate would be 422. If the company had been constrained by demand, it is easy to see that shorter setup times would have improved return on investment capital only if we could have used our productivity improvement to reduce the number of cabinet makers. We have considered a 1/3 reduction in setup times from 15 to 10%. Such a reduction in setup times is indeed feasible and possible. A second look at this table reveals that process improvements that yield a higher flow rate, setup times and lower labor content are having the biggest impact on return on investment capital. And this figure here below the table illustrates this logic. Independent of flow rate, we have to pay $992,400 per year for fixed costs, including the salaries for the cabinet makers as well as the other items discussed in previous lectures. Once these fixed costs are covered, or we exceed the break-even volume, every additional unit of flow rate leads to $2,625 increase in profit. As can be seen in this figure here, the small increase in flow rate leads to a big increase in profits. This logic is true for all high fixed cost operations such as hotels, airlines, and many other services. Here is a summary of the key steps of building a ROIC tree and evaluating potential operational improvements. Such a tree is a powerful starting point for consultants entering a new engagement looking at their client's operations. For a general manager who wants to have a comprehensive understanding of what drives value in his or her business, and for private equity investors that intend to quickly increase the value of a firm by fixing parts of its operations. In the previous lectures, we looked at a relatively small business and built an ROIC tree that was grounded in a detailed understanding of the company's operations. Alternatively, we can start the analysis based on publicly available data. Most often, this would be the case for larger companies. In this next lecture, we use the example of the airline industry to illustrate the usefulness of the return on investment capital tree method. The first step in our analysis is to identify firms in an industry that have demonstrated and sustained superior financial performance. In the case of the US airline industry, the prime candidate for a success story is clearly Southwest Airlines. Second, we built a return on investment capital tree as we did in the ABC Furniture case. When analyzing an airline, the following bits of airline vocabulary are helpful. Instead of thinking of an airline selling tickets, it is easier to think of an airline selling a revenue passenger miles. An RPM corresponds to transporting a paying customer for 1 mile. A flight from Philadelphia to Boston, for example, with 200 passengers would correspond 447 miles multiplied by 200 paying passengers, or which equals 89,400 revenue passenger miles. By focusing on RPM, we avoid some of the problems associated with comparisons between airlines that have different route structures. Furthermore, as we will see, variable costs for an airline are generally tied to the number of miles flown, so it is also convenient to express a revenue on a per mile basis. The capacity of an airline is determined by the number and the sizes of its aircraft. This leads to a measure known as the available seat miles. 1 ASM corresponds to 1 airline seat, with or without a passenger in it, flying for 1 mile. Airlines only make money if they can turn their available seat miles into revenues per mile. A seat with a paying customer is good, an empty seat is not. This ratio here is called the load factor. It strongly resembles our definition of utilization, as it looks at how many revenue passenger miles the airline creates relative to how much it could create if every seat were filled. Clearly, the load factor must always be less than 1. Other than small infants sitting on a parent's lap, airlines do not allow 2 paying customers to occupy the same seat. This figure here summarizes a simplified version of a return on investment capital tree for an airline. There exist, of course, many more levels of details that could be analyzed, including aspects of fleet age and composition, size of flight crews, the percentage of flying time of an aircraft, and so on. But since we are growing this tree from the left to right, any additional level of detail could be simply tagged on to our analysis in this figure. As a third step, we want to explore why the financially high-performing firm is doing better than its peers. A good diagnostic tool toward this end is the following method we call productivity ratios. We can write productivity as revenue divided by cost, and we can write labor productivity as revenue divided by labor cost. and see that Southwest labor is substantially more productive than US Airways labor. The Southwest labor productivity ratio is 3.31, which is almost 40% higher than the one for US Airways. The following calculations are illustrated with data from the year 2000. We use this old data for two reasons. First, from 1998 to 2000, Southwest managed to double its market capitalization, a financial performance that none of these competitors even came close to. So clearly, in the eyes of Wall Street, Southwest did something right. And second, following the terrorist attacks of September 2001, the airline industry entered a long period of bankruptcies and restructuring processes, which makes reading the financial statements during this period somewhat more complicated. But where does the productivity advantage come from? Are Southwest employees serving more customers? Do they make less money? From the ratio alone, we cannot tell. For this reason, we will rewrite the productivity measure in this way, or apply to labor productivity in airlines. Here is also the formula. It is helpful to break up this expanded productivity calculation into three pieces. Yields, the operational yield, revenue divided by flow rate, measures how much money the firm can squeeze out of its output, the flow rate. This measure is largely driven by the firm's pricing power. Efficiency, the transformation efficiency, flow rate divided by resources, measures how many resources we need to support the flow rate. This number is determined by how we utilize our resources. It captures the resource utilization, in our case the load factor, as well as the inherent processing times at each resource. How many available seat miles can a single employee serve? Cost, the cost of resources, resource divided by cost, measures how much of a resource we can get per $1 spent. The reciprocal of this measure is simply the cost of that resource. For example, the average early salary of an employee. Now let's see what this productivity ratio tells us about Southwest's source of higher labor productivity. Table here summarizes our results. The results of our diagnostics confirm US Airways' superior pricing power. Unlike the flow fare carrier Southwest, US Airways gets almost 50% more money for every passenger mile. Interestingly, both firms operate at roughly the same load factor. However, Southwest offsets its pricing disadvantage with the last two ratios. A Southwest employee is able to support 50% more ASMs compared to a US Airways employee, 0.53 as opposed to 0.37, while being paid about a 50% lower salary. For the same money you pay 47 US Airways employees, you can hire 67 Southwest employees. Note that this number has changed substantially since 2001. In fact, now Southwest employees earn substantially higher wages than their counterparts at US Airways. Wages have moved in the direction of productivity differences. We will continue with analyzing those operations in the next lecture. Let's continue with our analysis in this lecture. As a fourth and final step of our analysis, we can now look at how much money US Airways would save if it could imitate one or several of the productivity ratios from Southwest. For example, we can ask the following two questions. How much money would US Airways save if it could support as many ASMs with an employee as Southwest does? And how much money would US Airways save if it paid Southwest wages? This figure here summarizes the cost-saving opportunities. Consider the potential savings that US Airways would obtain from paying its employees. Southwest wages first. US Airways has 45,833 employees on its payroll. The average salary was $21,120 per quarter, compared to $14,922 for the average Southwest employees. if we paid US Airways employees Southwest wages, we would hence save $284 million. Next, consider the saving potential if we could have a US Airways employee achieve the same level of productivity as a Southwest employee. It takes US Airways 45,833 employees to service 70,212 available seat per miles, translating to 0.37 ASM per employee. As we saw in the table from previous lecture, Southwest is able to service 0.53 ASM per employee. So, using those data, we can calculate that 32,475 employees is the number of workers that US Airways would need if it achieved Southwest labor productivity. This leads to a possible headcount reduction of 13,358 employees. Given the average US Airways salary per quarter, this corresponds to a quarterly savings opportunities of $282 million. Note that the savings we would obtain from such an increase in productivity are not savings on top of the savings potential reflecting an adjustment of US Airways wages to the Southwest levels. In other words, the total combined savings from the adjustment in labor costs and the increase in productivity would not be $284 million plus $282 million. The reason for this is simply that once we have cut salaries, the savings that we get from reducing the number of workers to reflect productivity gains are smaller. That would be the new lower salary per employee per quarter instead of higher salary. So if we continue to compute the additional savings we obtain from a productivity increase, assuming that the US Airways wages already have been adjusted to the Southwest levels, we compute almost $200 million dollars in wages. This figure here also shows and analyzes another productivity advantage of Southwest, the company's ability to procure cheap jet fuel, which is a result of clever or lucky investments in fuel hedges. US Airways would save $108 million if it could purchase jet fuel at Southwest purchasing conditions. And if on top of it, it could match Southwest fuel efficiency, it would save another $35 million. Unlike the analysis that we did in ABC Cabinet Makers example, the approach summarized in this figure is much more a top-down analysis. Before entering the details of the operations, what does Southwest do differently that their labor can support more ASMs, we start out our analysis by broadly exploring the size of various opportunities. In general, the top-down approach is most useful when analyzing competing organizations or when there simply are limited data available about operational details. Thus, when the analysis happens from the outside in. In contrast, it should be emphasized that for the management within an operation, the level of granularity that we have outlined in this figure here is vastly insufficient. Sizing the opportunity is only the first step. The real challenge then is to cascade the labor productivity disadvantage further, all the way into the minutes it takes to board an airplane, the duration of the worker breaks, and the number of employees at the gate, and so on.